Evidence is mounting that the housing market in the United States is deteriorating faster than it did during the 2008 recession. This has fueled speculation that home prices will experience a more severe drop than many economists predicted. With 30-year fixed mortgage rates approaching 7% for the first time since 2008, demand for homes has fallen significantly from last year's peak. And according to the National Association of Realtors, July home sales were down nearly 20% year on year. Besides that, rent prices are up nearly 30% from last year, owing primarily to single-family rentals. And this reflects the fact that many would-be home-buying families prefer to rent rather than make a down payment on a house. But it's not just about demand. The United States recorded a 10.5-month supply of new houses in July, the highest level since 2009. Housing starts has also significantly outpaced household formation in recent years. That is to say, more houses are being built than there are people to buy them. The price-to-income ratios on homes, on the other hand, are perhaps the most startling. The PI ratio is 16,035, based on a median new home price of $438,067 and an average hourly earnings of $27.32. For context, the figure is the highest since the Great Recession, when it was $14,923. Home prices are out of reach for the majority of working Americans in relation to wages, which means that demand for homes is unlikely to return without a significant correction in real estate prices. Clearly, the real estate market has slowed from its previous years of rapid growth. The 2022 housing market resembles that of 2008. Depending on who you ask, the housing market may experience a widespread crippling recession akin to the 2008 housing crash, a more moderate pullback, or simply a slowing in home price growth. According to recent data, the price drop has already begun. In July, the S&P CoreLogic Case-Shiller Index, which measures prices in 20 major cities, fell to almost 16% increase. Meanwhile, in the Zillow Home Value Index is still up from the same month last year, but it fell on a monthly basis for the first time since 2012. This is one of the quickest reversals in growth in the index history. This has coincided with a significant month-over-month decline in a number of the regional housing market. Home values in Seattle, San Francisco, San Diego all fell in between 4 and 5% in July. A return of housing inventory adds to the general downward pressure on home prices. The level of housing supply reached in July was previously only reached at the height of the 2008 housing crisis. One of the major barriers to a true housing crash is the limited supply of available homes for sale. A rise in housing inventory may indicate that some homeowners are panic selling in fear of losing property value or out of economic necessity. In case basic economics tell us the low demand and high supply equals falling prices. With this broader perspective in mind, investors had it even worse in 2008, but 2002 isn't over yet, and this year has been filled with nothing but bad news. So buckle up and let's hope 2002 ends better than it begun. So guys, thanks for watching my video. If you want any more info, leave a comment down below. Give me a thumbs up, and nonetheless, hope you enjoyed it, and I'll see you in the next video.